Do a pitch deck review on Harvest Health, an investor presentation from earlier this year, doing 7 tips to a successful investment deck. So Harvest, we're going to grade their investment presentation based on 7 factors. Number 1, will they identify the business plan goals? 2, do they know their audience? 3, do they understand the market? 4, will they identify needs and roadblocks? 5, do they know what sets the business apart? 6, will they introduce the team and products? And 7, will they create a summary with a call to action? Let's find out. Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your cannabis business podcast. To dive into Harvest's pitch deck, it's Katrina Glogowski, angel investor and attorney. Katrina, thanks for being back on the podcast.
Thanks, Josh.
All right, let me share my screen here and we can dive into 7 tips to a successful investment deck. First slide they have after their disclaimer is why cannabis?
Why not cannabis?
Yeah, why not? That should be the question. So it presents significant growth opportunity over the next decade as more countries and markets embrace medical and recreational cannabis use, intersects with various industries, including pharmaceutical, commercial retail, health and wellness segments, and conversion from prohibition to legal markets provides an opportunity for disruption. All right, global opportunity. This is their total addressable market slide. Talks about the future of cannabis and how many gabillions will be produced.
Josh,
although they do say that. Go ahead.
Did you know that cannabis is a multi-billion-dollar market? Could you even guess that?
I've never even heard of cannabis. I don't even know what you're talking about. No, but seriously, they point out that cannabis is legal in at least 2 countries, and that's Canada and Uruguay. But Mexico was right on the tail. Been a lot of stuff happening, but I'm sure that there's going to be Mexico's right on the border there, on the cusp of legalizing.
Right.
All right. So why U.S. multi-state operators? So U.S. MSOs, they lead the industry. So the United States is at the forefront of the movement towards mainstream acceptance. They go on to say that the U.S. global launchpad for cannabis culture, product development, and trends, with the market expecting to reach $25 billion by 2023, despite greater opportunities over the next decade. U.S. multi-state operators are going to trade at lower valuations than their Canadian peers. And with current regulatory environment providing a unique opportunity for U.S. MSOs to build out assets with limited pool of competitors. So there is a kind of a barrier to entry. You need some capital, but I think some of the benefits are you have assets, right? There's a lot of real estate, even though commercial real estate's never been more expensive, and then people aren't really utilizing a lot of commercial real estate. There's a potential to drop as Amazon might work from home, and Microsoft, even Goldman Sachs is talking about leaving New York for Florida. There's a lot of uncertainty. So I don't know if multi-state operator investment is the way to go now, post-pandemic, but it sure was.
I like MSOs in concept as an investment vehicle. I think MSOs as a concept are a little bit better for investment dollars than an individual operator in an individual state.
Yeah, being a non-producer processor, it makes them a little bit more appealing to investors. IIPR, ticker symbol, is a real estate investment trust in cannabis, taking advantage of companies like Forefront Ventures who were doing sale leaseback options and getting really good favorable terms. But again, that's based on assets at the highest market price they've ever been in history. So there's a plus minus. I mean, go with the flow until, hopefully they're hedging their bets, right? You would hope.
Right.
But I do think that they're appealing. Some investment firm, like if you're in a family, you can't really invest in sin stocks in some cases. Pension plans, whatever, have limitations. So maybe MSOs are that exception, but regardless, there's opportunity, I guess. So let's continue on here with the majority of U.S. supporting legalization. Over 66% now support it. Obviously, there's going to be more because they need that cashola.
Mm-hmm.
All right, they've added a few more states since this pitch deck came out in January of earlier this year. Actually, this map is from September of 2019, so it is definitely outdated, but essentially they're just trying to give you a forecast and create some FOMO. That's the point of these slides. All right, getting into the secret sauce and what separates Harvest from the competition potentially is their leading the industry. So short term, each state represents a challenge and opportunity because of the unique regulations. Medium term, they have a field of large scale, well run MSOs with narrow over time. Already leading to see emergence of market leaders with significant footprint, assets, and capital. And in the long term, the MSOs with scale and efficiency, they're going to generate sufficient cash flow to compete at standalone businesses and provide immediate entrance to U.S. capital markets for potential interested acquirers once barriers are lifted. So they've got an exit strategy. That's good. That's what you want to put in here, is that you're not trying to create a legacy, right? Nobody wants a Larry's Handy Mart and a sea of 7-Elevens. And so everyone's trying to kind of get out at the highest valuation possible.
Right. So far, so good, Josh.
All right. Cruising along. So why harvest? Kind of leading up some FOMO here and then dropping the mic with leading U.S. multi-state operator. Excuse me. Well-positioned and an industry leader, combining targeted strategy, best-in-class management team, and disciplined capital allocations. Rooted in Arizona, founded in 2011. They've got some entrepreneurs and pioneers, and combining organic growth and strategic acquirers, they've grown to become one of the largest multi-state cannabis operators in the U.S. We've got some interesting numbers here. 35 processing licenses, 130 retail licenses, 20 brands, 45 cultivation licenses in 13 states. 8 with multiple retail locations like Washington. They bought Have a Heart and immediately got into a lawsuit, and maybe we'll get into that. Maybe we won't. Actually, we probably should, because that's part of the needs and roadblocks. If they don't address that, we will.
Right.
So they have $900 million market cap, $380 million in revenue, 950 employees, founded in 2011. So quite the statistics.
Those are impressive numbers, Josh.
They are. Could have been maybe neater, but it's right there. It's in your face. You just have to spend a few seconds reading it.
Mm-hmm.
All right. So again, they're well positioned for the opportunity ahead. Their vision is to become the leading purveyor of cannabis brands while capitalizing on market-specific opportunities. Their footprint, they've got one of the largest portfolios among U.S. multi-state operators for rights to build out facilities in the U.S. obtained through a combination of organic licenses, awards, and mergers and acquisitions. Their financial strength, they've got access to multiple capital sources, including real estate and secured debt financing, with a management team and board of directors experiencing across multiple disciplines, including legal and regulatory, real estate. They don't mention finance, so they get 1 point taken away from me for that. All right, their strategy footprint is to have combined organic growth through licensing and, again, the M&As and organic growth. Their operations are focusing on expanding across cultivation, processing. Hopefully those operations include, positive cash flow and revenue, like real revenue, profit. They've got at least 20 brands, so impressive brand portfolio. And their cultivation and manufacturing. So we kind of mentioned out some of those statistics with retail dispensaries, and a huge list of where they're at between, opening them up themselves, acquired, or otherwise. They're in Arizona, California, Florida, Maryland, North Dakota, and Pennsylvania. So Washington's not on this list. They have 5 stores in Washington from Have a Heart. So I'm assuming that deal must have happened after January. I thought it was before that.
I can't comment on that, but I do like the slide of giving live addresses of their locations, which allows a potential investor to Google it and confirm it and research it. So good on them for including actual live locations. That's a very good sign, Josh.
Yeah, it's a nice little slide here. I probably would have thrown that in the appendix, but it's a good slide to have somewhere. All right, finally getting to some financials. I believe, Harvest is publicly traded. I don't know if they're on the Toronto Stock Exchange or the Canadian Stock Exchange, but they are publicly traded. So they have some financials from first and second, third quarter of last year. And it looks like adjusted EBITDA is getting worse as time goes on. Pro forma revenue is increasing, actually doubling from first quarter to third quarter, from about a 50% increase in revenue.
Well, some of this can be explained by their acquisitions. Uh, Number one, buying an up and running operation costs more than applying for a license, but it can also account for the jumps in their revenue when they're already selling the day they buy it.
Right. And we made that comment when we were covering Curaleaf's deck too, is that it's really hard to look at their financials and guess one way or another, because excluding same store sales, you don't really know what you're looking at. So it's kind of hard to say what's growth, organically, and what's purchased, like you
Right.
mentioned. So, all right. Some of their overviews: revenue went from 350 million to 700 million in 2020. That's their guidance or their pro forma estimate. It's range on both multiple scenarios depending on availability and timing of capital. Capital allocation. They're focused on improving operations across existing asset base and further penetrating into key states with, again, Arizona and California, Florida, Illinois, Maryland, and Pennsylvania. So definitely got their hands in a few different cookie jars. The timing and magnitude of capital allocation depends on availability and reasonable costs, but could, obviously could provide the upside, like they mentioned.
Right.
So valuation is depressed versus their peers. So they're trying to give you some key performance indicators.
This is actually a very nice slide. We do not often talk about valuation on this podcast, but due diligence would show a comparison of their valuation, and to have them come right out and say, hey, we're undervalued compared to some of our peers is in fact useful information.
Mm-hmm.
Talk about knowledge of your audience. There you go.
Yeah, I just spoke to a CEO of an event company yesterday, and he said he had to go out and get financing during, post COVID. He applied for PPP and got a loan that way to kind of stay afloat. Had to lay off his entire staff, and then had to go out and get some financing from investors, and had a seriously depressed valuation. So valuations are getting hit hard, especially if you're not retail. Everyone else is kind of struggling to either continue to produce or stay afloat.
Yeah.
All right. So in summary, the cannabis industry presents a significant growth opportunity and lies at the intersection of pharmaceutical, consumer packaged goods, health, and wellness. And the U.S. is the launch pad for development, which makes sense, right? I mean, everything up in Canada is publicly traded already. And so there's a lot of speculation kind of leaving the U.S., some opportunities there. A lot of these companies are private down here. So looking at the U.S. for the future. Current regulatory environment providing a unique opportunity for MSOs, can build out assets with limited pools of competitors. So in the long term, MSOs with scale and efficiency to generate that cash flow to compete in standalone businesses and offer immediate entrance into U.S. cannabis markets for potential acquirers. Looking at exit strategy right there. Well positioned as one of the industry leaders, combining a targeted strategy, experiencing management team, and disciplined capital allocation. And that is it. So, yeah, it kind of reminds me of maybe doing Tilray's pitch deck coming up soon, because I would imagine their exit strategy is all about somebody buying them, because they don't do anything. But I digress. All right, so let's pull up the 7 tips to a successful investment deck. Number 1, did they identify the business plan goals?
I think they did. They want to grow.
I would agree with that. Yeah, they want to continue to expand and get global dominance. All right. Do they know their investor audience?
Some of the slides they put in there definitely indicated they have dealt with investors before. I think that they could have done a little better with that, but I'm going to give them a point because we don't often see valuation slides. We don't often see true live financial slides. So I think they did pretty good with that. I'm going to give them a point.
I would give them a full point for slide 24 that shows valuation is depressed versus peers. It's a slide I haven't really seen before, especially kind of busting out some of these key performance indicators. Yeah, I would definitely give them a full point for for that. I think they definitely know their investor audience as well as the market. What's your take? Do they know number 3, understanding the market?
I think so.
Okay. That easy. What about needs and roadblocks? Did they get a full point for number 4?
I will say that buried in the slide somewhere at some point, they did mention that their growth is contingent on obtaining licenses and or closing deals and or regulation burdens. And so I understand that they put that in there, but I did not really see what they needed to overcome those roadblocks outside of a request for money. So I'm going to give them a point because they did say something about it, and people, entrepreneurs, frequently do not mention the regulatory burdens or ways that the business could run into trouble, and they did.
I'm going to go with half a point on that one simply because they didn't put anything about overproduction. They didn't say anything about, any potential issues with 2.0 because there's a lot of new products that came out in January. They didn't mention 2.0 at all. And that's exactly, when this deck came out is when all those 2.0 products became available in Canada. So not foreseeing that everyone was going to be closing down $250 million greenhouses that we've seen from Canopy and Aurora and the $3 billion write-offs and all of that. Like, you didn't mention any of that. So I'll be generous and give them half a point for needs and roadblocks. Number 5, do they know what sets the business apart?
This one, I don't really think they did a very good job on this one. They do talk about global domination and expansion, and because there are many states that they can reduce costs. But I did not see a lot of competition. They said we're better than the competition. Okay, how? Are you telling me you're better than MedMen? That doesn't mean very much. Are you telling me that you're better than some of these other MSOs that you were totally silent on? That really bothers me. You need to understand your competition, and maybe they do, and they just didn't tell a potential investor about it. And I personally don't like that. It's a pet peeve of mine. So 0.
0. All right. I think they try to make I was going to give them half a point because they tried, there's a few slides in here that says why harvest, right? And they're kind of building up to that, letting you know that there's this total addressable market and we're dominating and here's why we're better. I think they failed at it. I think they made the attempt at trying to say, here's our secret sauce and this is what makes us best. They're the leading multi-state operator and they list all of these things, but we've seen decks from Curaleaf and MedMen and these other multi-state operators, and I don't think it went into enough detail about how they're actually different. Why would people go to this store over MedMen? What are the production qualities or differences on how they're growing? They didn't even get into the brands at all. I mean, we'll get into that in number 6, but I'll go with half a point because I think they tried to address it, but I think they failed miserably. So what about number 6, introducing the team and product? I mentioned that I didn't see anything about brands. They said they have 20 brands and they didn't mention not one of them. I don't know who the CEO of Harvest is. I don't know who the advisors are. I don't know who's running the show, but I do know that MedMen is a dumpster fire, and we know what happens when bad management is in place. So not highlighting who the good management, who is actually running this show, is sort of your differentiator and your secret sauce. So they get an absolute 0. Like if I could get them negative points, I would give them negative points, but they're getting at least 0 for me on that one. Where are you at?
I agree with your comment about, is it even possible to give them a negative point? Because this is a publicly traded company, so that the board and the management and leadership of this company is public. How come you can't give me a slide so that I don't have to look at it? And I agree that if it was possible to take a point away, it is a pretty significant failure of this deck.
So someone started making this in the fourth quarter of 2019, and they released this January of 2020. They should have been a little bit more proactive in understanding that the pandemic was oncoming, was going to be an issue. Because I mean, I bought my mask in November of 2019. So I'm one of the early ones. I saw crazy stuff happening in China, but I'm just saying that if you have risk analysts, or if you have anybody who's got any kind of risk aversion, they should have been seeing that and then putting that in the deck to say, this is how we're going to respond. I think Cureleaf, actually, their very first slide is, this is our response to the pandemic.
Mm-hmm.
So not having the team in there to let us know that they've got the personnel to get us out of the crisis, I think is a huge missed opportunity. But did they create a summary, or did they just kind of leave us hanging? Number 7 is create a summary with a call to action. I think towards the bottom, they kind of gave us the numbers a little bit with the summary. I mean, they do have a summary, but is it enough for a full point?
We've talked about this with other publicly traded companies, Josh. It's very hard to solicit funds. They don't talk about an ask at all. They don't say we're, raising $5 million and these are the terms. But I understand why they didn't do so. They do have a telephone number. If you want more information, give us a call. Yeah, I'll give them a half a point, with the little asterisk that being a publicly traded company does highly restrict your call to action.
All right. So I think that's 4.5 out of 7, which gives us a 65%. So not too shabby. All right. 4.5 out of 7 for Harvest Health. Not too bad. Couple of things that maybe they could have done better, just to recap, that is obviously identify needs and roadblocks, maybe know what sets the business apart a little bit better with competition. Obviously, you should introduce the team and products. My gosh, what a huge missed opportunity that is. And then try to create some FOMO. We're not asking for too much, but when you have that summary in there, put in something in there that's a little tantalizing, that gets somebody want to pull out a check and a pen if they still have checks and pens.
One of the other things they could have done, because they are on the stock exchange, they could have demonstrated how their stock price has changed since they got on the market. Because I didn't invest 2 years ago, did I miss the hockey stick, or are they plummeting, or what? So they did have an opportunity to create a call to action, create a summary. Again, this is public information that's not going to disrupt their secret sauce just by disclosing the previous performance of their stock. That's what I would tell them. I agree wholeheartedly that the team failure to disclose the team is almost fatal to this deck, given that it's a publicly traded company. And they do have some opportunities to excel here. And they can do some revisions and probably have a 7 out of 7 pitch deck with just some minor tweaks, Josh.
Mm-hmm. Yeah, absolutely. I mean, I might have been adding a little bit more in there too, in the appendix. Again, kind of going back to Cureleaf's deck, they had 5 to 7 different states in the appendix to kind of give you an idea of why that investment in Florida or Illinois or Massachusetts was a lucrative opportunity. So as they're kind of talking about their expansion and that they have this global dominance, well, maybe include that in your appendix so that someone can go in there and see that you do have a thorough business plan, that you have an idea of how to get in there and why is that future market an opportunity for somebody who doesn't know about the intricacies of cannabis or that particular region. I would maybe include that as well, because if your whole goal is to be a multi-state operator, then tell the audience a little bit more about where you're going and why that's an opportunity. That's really kind of what's setting you apart, is your vision and where you're going and how you're going to make more money than the competition.
Agreed.
All right. Until the next time, we're going to roll this one up. I want to thank my guest, Katrina Glogowski, angel investor and attorney. Thanks for being back on the podcast.
Thanks, Josh.
With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.